hello, and welcome to the Retire to a Life You Love podcast with your host, Michelle Gessner. I'm Wendy McConnell. Well, hello there, Michelle.
Hey, Wendy, how you doing?
I'm good. I'm loving your bright red shirt, and it's just making everything pop.
Yeah, well, I had to do something to wake myself up today. It was crazy day.
But we do
Wendy,
have some guests, right?
we do. We have guests. I am so excited because we have been able to get our investment team on this podcast episode, which I'm excited about. A lot of people want to hear from them. The true investment professionals. So I'm gonna introduce them in just a minute. We're gonna talk about our investment philosophy. We're going to talk about recent market events. We just had a big one yesterday with the election. It's going to be a good one.
Okay, so let's get started.
Sure. So we have James and we have Arch today. Both are from Aptus Capital Advisors. Aptus is an extension of us. They are true experts in investments. And I'm going to have them tell you a little bit more about themselves. Who wants to go first?
Well, I'll always, I'm Arch. I'm always happy to talk about myself. So I'm fairly shameless. My name's John Archbold, and Michelle, Wendy, thank you so much for having us on. It's great to be here. Very briefly about myself. I've been an investment professional now. I'm in my 20th year. Which is pretty wild. My hairline certainly reflects my time in the business, in that it's fairly non-existent at this point. But a fairly traditional, I would say, path that a lot of folks have taken. So I started right out of college in the mutual fund world, cut my teeth there for about 5-6 years. And then I spent some time myself as an advisor in the late 2000s. So following the 2009, 2010, I guess it was really 2008 to 2009 crisis, and then 2010, really struck out on my own to start my own practice and started from scratch. Now, at the time, I was 28 years old, and I realized a pretty harsh lesson fairly quickly that everybody with assets the only people with assets were old enough to be my parents. When was the last time my parents took financial advice that I gave them? So after about 2 years of running into that brick wall, I spent some time in the private credit, private equity world for about 5 to 6 years. Started working on my charter at that point. And then once I completed my charter, ever since then, and really for, I guess, 8 years now, have been in the high net worth investment space. So once I wrapped up the charter, that's where I landed. And really my focus and my passion is working with investors on building comprehensive portfolios, particularly within a financial plan. I think the work that you are doing is so important. Because if there isn't a financial plan around the investment decisions become meaningless. I truly believe that. And so that's a really big passion of mine. Is the importance of matching the financial plan to the investment portfolio. Aptus is laser focused on that. And so when I was approached with the opportunity to join Aptus, I jumped all over it. I think they've got a phenomenal investment discipline. We're going to go through that, and then of course the partnership with elite advisors. To really build comprehensive financial planning and investment decision making. Those are things that to me are just, again, people are not doing enough of that, and it's something that I'm very passionate about. So it's really great to be here and be a part of your team.
Well, I appreciate that. Now, before James introduces himself, I just want our listeners who may not know what getting my charter means. Can you tell people what that means? It's a CFA that you're talking about, right? Tell people what that stands for and what that is a little bit.
Yeah, for sure. Without sounding too self-aggrandizing, the CFA stands for Chartered Financial Analyst. These are the charters issued by the CFA Institute, which is based in Charlottesville, Virginia. It is a fairly rigorous program. The pass rates are very low. I think the numbers are around 21% of the people who begin the process. Only 21% actually complete it. It takes usually anywhere from 3 to 4 years to accomplish it. I want to be very clear about this, though. This is not an intelligence test. It is just a test of your capacity to suffer. As a lifelong Philadelphia sports fan, I'm very, very well acquainted with that dynamic. So I was very easily able to adapt quite easily to the CFA program, but it is quite rigorous.
I think you're cutting yourself a little short there, because I've heard it is absolutely, it requires, some intellect. And so don't sell yourself short there.
I will say this. I was very glad that I was wrapping it up just when I met my wife, because I think if she had met me when I was in the midst of it, I would not be married and I would not have, we would not have a family right now. So I am very grateful that I met her just on the tail end of that, because I think that would have been a little too much for her, because she wouldn't have seen me for about 6 months.
Yep. I've heard. So James, tell our listeners about yourself a little bit.
Hey, Michelle, thanks for having us. So I'll keep it short. I've worked as an advisor and with advisors since 2010, so coming on 15 years now. I've been in the insurance space, been a financial planner, and really found my love in the business working with independent RA firms. And that was through TD Ameritrade for almost a decade. And how I got connected with Aptus back in 2020 was they were my client, and they just had a really differentiated business model and services for financial advisors. And so I get to continue to work with independent RAs, fiduciaries, which your firm is, and it's really something unique and special as far as advice, financial advice in this world we live in. And be part of a really interesting, compelling team. So really thanks again, Michelle, for having us.
Yeah, no, I'm really glad that you're here, because I talk to people all the time about investments, and I probably tell them most of what they care to know. But there are folks who really want a little more color around investment topics, and so you guys really needed to be on this show. So what I'd like to start out with is market events. We just had a big one last night, the election. Without getting into politics, nobody wants to do that. But let's talk about a little bit how recent market events have impact on investments and the market and asset allocation decisions.
Yeah. So from there, Michelle, I think it's, and I think what's great is that, there is a lot of data, and I think that it is really difficult in this time, no matter how you felt about the election yesterday. It's really important to remember that when you look at the long-term returns of the markets just really are indifferent to who's in office, who owns Congress, who's in the White House. Vanguard, although I'm loath to quote the competition, but Vanguard did a great study on this over the last 100 years. The return streams for bond and stock portfolios are identical under both parties. So I think that's really important. But what is important to remember, I think especially when we're positioning portfolios is, history, while again, past performance is no guarantee of future returns. We all know that, but there are certain patterns in the market and how things take place. And I think, one of the things that people always need to remember, especially with these events like an election, particularly that we tend to see markets rally quite heavily following the election. It's sort of like everybody just takes a breath. It's like, oh, okay. All right. That's over. Right. And so we've seen that today. We're seeing the market rally. And this is very common to see a strong rally once the election is over through year end. And I think what is helpful to remember is really there is sort of a 4-year pattern to how equity markets in particular tend to perform during a 4-year presidential cycle. So we tend to get a strong rally into the first year, and the first year tends to be pretty good for the market, typically. Now, the second year is that's always the worst year. That's what we've typically seen is the second year is the worst year for presidential cycle. A big part of that is the uncertainty around midterms. So you're typically in a midterm cycle, and there's a lot of uncertainty around policy and what will happen there. And what usually happens is the party that lost the White House in the presidential election typically has gains and will usually win either the House or the Senate or both in the midterms. And then following the midterms, then you get into the third year of a cycle. And the third year of a presidential cycle is usually the best one. And that's actually played out during President Biden's administration. So the first year, 2021 was largely pretty good. A lot of those gains were in the beginning of the year, and then the market was kind of on a sort of a flat, sort of kind of up and down through the rest of 21. 22, of course, we had a pretty rough year. We had a bear market for both bonds and stocks. Then 23, third year, was a great year. And then by avoiding a recession here so far, knock on wood, here in year 4, we've also had a really strong market. And then today, the market return has been quite solid, indicating that we may get that year-end rally that we typically tend to expect. So, I think those are the things to keep in mind as we move forward here. It's important to, when you think about our approach, and we'll talk more about it, but really, I think our head of equity, Dave Wagner, has a great expression around building portfolios for the long haul, which is allocations like a pie crust. The more you mess with it, the worse it gets. And so the less we can do, right? The less we can do, and having more permanent strategic, when I say strategic, I just mean long-term allocations, that tends to result in the most consistent outcomes for folks and keeps folks and it really manages the behavioral aspect.
Well, I have 2 comments. First off, I've heard that investments are like a bar of soap. The more you touch it, the less you have. But I like the pie crust too, because I'm a pie maker, and I I totally understand that. But the other comment that I have, or question rather, so when you're talking about markets and the election, it sounds like you're saying it really doesn't matter who wins. This is what happens no matter which party wins. It's just this cycle that you're describing. Would that be accurate?
I think that's very fair. And especially in an election where, again, I might be getting a little over my skis here, but in terms of how people feel about it, but on the economic front, what I think was interesting about this election is economically, the parties were not that far apart. Both are no matter who won, Harris or Trump, you were going to see deficit spending, and that was going to continue. And so that was going to be stimulative for the economy, right? So the government's deficit is what goes into the private sector. And so I think particularly for this election, that is why that holds true. There's no party right now talking about austerity, which I think is very different than what you've seen in past elections, particularly coming out of the 2008 cycle where we had the Tea Party movement, which was really focused on austerity and limiting government spending. That was very different from what we have today, where we have both parties are going to look to spend, and that will go into the private sector. And so that is, again, why I think you're seeing the markets rally, is that it was really dealing with the uncertainty of which candidate it would be. And now we can all take a breath and we all just move on.
Yeah, and markets hate uncertainty.
Hate it.
Yeah. James, what would you like to add to that?
Yeah, I was just going to maybe take a different spin on, I guess, recent market events and not talk politics and more talk about the interest rate volatility that we've seen here recently, and the importance of the Federal Reserve going forward and managing the dual mandate that they have: unemployment and inflation. We've experienced a rough patch of inflation for the first time in quite a while here coming out of COVID, and it's going to be really important that they make the right decisions for us to maintain what we would hope and stay out of a recession. As much as it may seem like everything is all well and good here in markets, there's been a ton of volatility with rates. The Federal Reserve last month cut rates 50 basis points, and the longer end of the curve went up, which you as an investor may not think too much about the 10-year and how that impacts you and everything, but that is pretty closely connected to the 30-year mortgage rate, which if you're looking to move and you were hoping that your mortgage rate went down, that very well may not be the case. So all eyes on the Fed. There's a meeting here this week, and as we look at expectations going into 2025, trying to navigate that is certainly going to be important for us to stay out of recession territory.
Yeah, that's a good point. I know people worry about that. I'd like to kind of go into, if you don't mind, I'd like to go into a little bit more about your approach to investing. And I know that you could spend 2 hours or more talking about that. But if you can give us the highlights about, what's your philosophy? What's your approach to investing? And I don't know which of the two of you would like to start.
I can start that conversation and let Arch add all the extremely intelligent points soon after me.
Pressure's on to me.
So as it relates to thinking through different sectors of the market where you might invest, or making a huge bet on international versus domestic, that's really a loser's game in our mind. Yes, you want to have balance, and you want to maybe have overweights to certain areas of markets, but that thesis has to be much more long-term and not short-term in nature for us to say, yes, we want to overweight to small caps, for example. So that's, I guess, where we would start. And, since 2020, we look back at the traditional way to manage portfolios. Let's say the 60% in stocks and 40% in fixed income, and that has knocked it out of the park. Like the traditional way to invest, the way we maybe were taught in school to allocate a certain percentage to stocks and bonds, has worked really well for investors. But the caveat to that is we've had ultra low inflation, and we've had a rate environment where interest rates have gone down, which has appreciated the value of your fixed income portfolio, and it's been a nice buffer on the downside. But now we live in a much different environment for bonds, and our belief is if you're going to take a fixed payment for which would be a bond that doesn't have any growth characteristics in an inflationary environment, or an environment where maybe you do need to have a little extra growth in your portfolios, that in all cases, whether you're a preserve investor or aggressive growth, we're trying to tilt the odds to own more stocks in our portfolios, and less fixed payments or bonds. So we're doing that while keeping risk neutral through options, which we'll get into a little bit. But the biggest impact to any investment plan in our eyes, and this comes directly from Vanguard, over 90% of investment success over longer periods comes from asset allocation. And so if you can get that right, if you can get that combination of stocks and bonds right, then a lot of the underlying bets on international versus domestic isn't as important, or a particular security. So that's where we're focused. And our goal is to own more of the securities that have growth, which would be stocks, in any case, to allow investors to compound capital more over periods of time. So Arch, I'll let you add to that.
Yeah, for sure. Thanks, James. No, and I think, when we think about owning more stocks, we're really trying to deal with that risk of inflation. So we're in a fairly unknown environment. Now, the hope that everyone has, so James referenced the 10-year moving up. This has happened in the past following a Fed rate hike cycle, and then the Fed cutting into a growth cycle, which is what's really happening right now, right? We haven't had a recession, but the Fed is now cutting rates. And we've seen the back end of the yield curve move up. Now, this happened back in 1995. And that was where we got the famous, for those who pay attention, right? We had that in 94. We had a very severe rate hike cycle. And then in 95, we saw that reverse. And then we also saw the back end of the yield curve move up. We all know how the late 90s played out. That was a great environment. And that was the soft landing. And the good news is, I think there are a lot of indicators that that's exactly what's taking place. But as James points out, look, we're not trying to be in I say this all the time, we're not trying to be in the prediction business. We just want to be in the risk management business. And so the other risk, though, is that what the yield curve could be telling you is that inflation will resurge. We'll have a resurgence of inflation. It's going to come back, right? So the Fed is engaging in deficit, or not the Fed, excuse me. The Treasury is engaging in deficit spending. Government is spending into the economy. We're not having a recession. And so that could trigger another inflationary cycle. And what that means, to James's point, is that we want to own more stocks. Now, your listeners, while you're hearing that, and thinking, well, John, if I own more stocks, isn't that more risky, right? Because I have to wait, I'm taking on more risk. Well, you're trying to deal with two risks. So we have the additional exposure to stocks to deal with that risk of inflation. The only way to deal with inflation, grow your way out. So that's what we're trying to do. Grow your way out of inflation and grow beyond it. Now, in order to do that, rather than using bonds as protection, because in our view, especially in the current climate, our view is that bonds are not going to be the best protection in this environment where if markets were to go down. I can get more in depth on that. If any of your clients want to hear more about that, I'm happy to go through it because we could spend about the next 2 hours on why that is. But rather what we do is what we want to incorporate options, particularly things like put options. Now, put option is the right to sell a security at a specific price for a specific period of time. Let me translate that to English. Think of it like car insurance. So for instance, the analogy I always use for folks is to think of it as, why do I feel okay driving my car? What happens if someone hits me, right? And I have an accident. Well, I've got insurance. And so I make a payment every month, and then I get a big payment, lump sum payment for repairs, or if heaven forbid the car is total, a lump sum payment, I can go out and get a new car. That's how puts are functioning. So what we think of is at Aptus is that what we want to do is own more stocks. And then what allows us to do that is owning those put options, because that's going to be true downside protection against drawdowns, because protecting against drawdowns is really important. And here's the other important concept that I want to make sure people take away from this, because I hear this sometimes, most clients tend to be a little gun shy, but you often get clients also on the other side of the spectrum that will say, and I'm sure, Michelle, you've heard this, right? Michelle, I'll just want to own the S&P 500. I know in the long term what stocks do for me, and I can ride out the volatility.
Yep.
The thing that these folks, what I try to educate folks about is that you're now injecting luck into into your financial plan, and we don't want to do that. We don't want to incorporate luck into the program as much as we can avoid that, because you have to remember the average drawdown in a bear market for the S&P 500 going back nearly 100 years is around 40%. That's average. That means half the time you have a bear market, it's going to be worse than 40. And if you have that event up front, you have a real problem.
Yeah. Sequence of returns.
Exactly. And so what we want to do is for that client in particular, speak to that client that's a little more pro risk, is to say, look, we're really glad that you're pro stocks, because that makes this conversation a lot easier if you're comfortable with that. Think of it like, you're driving your car. Yes, you have a gas pedal, but would you ever drive a car with just a gas pedal and no brakes and no seatbelt?
Nope, not me. Not me. And I want to reiterate something that you said, just in case the listeners did not catch it. A put option is a security, and it gives you the right to sell at a pre-designated price. Did I get that right?
That's right.
So that's the part that everyone worries about, right? Oh my gosh, what if the stock I own drops in price and now it's not worth what I thought it was going to be worth? And so the put option is literally injected into that basket of securities to allow you to get some risk mitigation against that event happening.
Michelle, you're spot on.
Well, I think what I didn't end with is what happens when, so the market draws down and now you have this put option that it lets you sell at the price that is obviously higher than what the market dropped to. And so you're able to do that and recoup some of your money. Is that right?
That's exactly right. That's
Okay.
that's perfectly said. So the put option itself goes up in value. Right? So you bought the option before, this event happened, because now all of a sudden everyone wants insurance. It's essentially like you bought the fire insurance, and now everyone's home is on fire and everyone's running around saying, well, how do I get this fire insurance? And you're the one holding it. And so that's where you're able to sell that. And we call that monetizing it, because now I have cash in hand. And then critically, what I can do with that is two things. I can reset my downside protection, and then I can buy more stocks. And see, this is the key thing that folks need to recognize about compounding returns. When you buy more stocks, when markets are down, you buy more shares. You have greater ownership of these historically great businesses, right? And these businesses that are paying dividends. And the more shares you own, the more dividends you collect. And the way to compound is to be able to use that insurance to reset your portfolio, reinvest back into stocks when they're much cheaper. That's going to give you the lift coming out of the bear market, but then also reset your hedges, right? So you can go and buy more insurance to make sure you also cover yourself for the stocks you just bought. Now, people might be hearing this and wondering, well, wait a minute. Okay, this is all great. Why isn't everybody doing this?
I get that a lot. So please address that.
So the first thing is there's only been very recently in the last 4 years, regulatory changes that allow for the incorporation of active options within the ETF or exchange traded fund structure. The ETF, for those who are listening that don't know what I'm saying, it's just think of an ETF. It's that same regulation that runs mutual funds. So an ETF is governed under the same regulatory framework as a mutual fund. The ETF has certain inherent tax advantages to it. And this is really important because typically the resetting of hedges, like I just described, and the active management you need to do generates a lot of taxes. So for this will drive your CPA nuts if we were doing this just on its own without this framework, because again, it's going to really drive up your tax bill. And it's very difficult to do this if you don't have a structure like an ETF. So this is very new. And so this is something that we're trying to, again, at Aptus, we're trying to educate folks about, because again, what's crazy when you think about it is back in 2016, this really wasn't something that was available to you. And as we sit here today, it is.
So just to be clear, it's not new. It's new. What's new is that this is happening inside the wrapper of an ETF, which takes care of the tax problem.
It's much more tax efficient. That's correct. And then moreover, when you think about it, if you're trying to, and again, this is why options and this sort of hedging, this is what I'm describing, what we're talking about. If you want to use the fancy technical term, it's called long volatility. If you want to use the fancy institutional language, but long volatility has been around for forever. And it's been available in the hedge fund structure, but typically you would need $1 million to $2 million to dedicate just to that, right? Just to that kind of a framework in order to have access to this type of management. And also the hedge funds don't get that advantageous tax treatment. And what's interesting is I've noticed this within the volatility industry, because I've been following that for a long time. I've noticed a number of folks that I was following that I'm a fan of, a number of portfolio managers, star volatility managers that have actually gone and transitioned to the ETF world for those very reasons, that it's just a more advantageous structure than a hedge fund structure from a tax perspective. And then the beautiful part of it is that as the client, it's very transparent. You can look at it every single day and see all the holdings that are underlying. You see everything in there. And again, it's something that is going to be much more tax efficient for you, and we can actively manage it as well. So all of those different components come together where now we can build portfolios that were typically only available to very high net worth, or extremely high net worth families or institutions. But now, we could even build this for somebody who, again, has $50,000 and just wants something to look like this, an IRA rollover. You can do that. And then it's a wonderful innovation. And it's great for individual investors to be able to have access to this.
So again, the puts give us the ability to shift the asset allocation. So our 60-40 is closer to a 75-25. And you're like, well, if you own a hedge or own a put, and in most environments, markets go up. So what does that mean for the return of the portfolio, given that I have an asset, a put, that is going to decrease in value as markets go up? And this is why I get frustrated, because some of these strategies that are now being made more available are maybe being misused in a lot of cases. And so the point I would have is that you can comfortably own a hedge because of the asset allocation, because you have 20% or so in an asset that's growing, stocks. When markets move up, the asset allocation is where you're going to have differentiation in your ability to compound capital. And then on the drawdown, on the left tail side, when markets do, there is some type of event, you still have fixed income. If that buffers a downside, great, but you have this additional mechanism or tool to help manage risk and keep that risk in line with the traditional 60-40 because you have two different tools to mitigate drawdown.
Yeah, that's helpful. And I just, in case any of our listeners are wondering, what is fixed income? I'm just going to, every time I say that, it's bonds. Okay. When he said fixed income, he meant bonds. So these portfolios, just to recap, they contain some bonds, they contain more stock without raising the risk, which would be normally the case. When you have more stock, you're going to have more risk. But the reason they're able to have the same risk or less is because you have an infusion of those hedged equities, otherwise known as put options. Did I get that right?
You got it spot on. I think the easy way to think about it, if you're like me and you love Formula One racing, and I'm very excited because my team, McLaren, may win the Constructors' Championship this year. We'll see. But if you ever watch a Formula One race, you'll see these drivers going to 45-degree turns anywhere from 200 to 250 miles an hour. And you think, my goodness, how do they do that? Well, the reason they can do that is they've got better brakes. Right? Yeah. So if you have great brakes, you can have a bigger engine and you can drive that car faster into that turn. And what that also allows you to do, right, is you think about it from the other side, right? When you come out of that turn, what are you trying to do? You want to accelerate. And that's the portion of the portfolio where when the puts go up in value, right? So we get a turn in the market. We've got those brakes that allows us to turn with it. And then the additional money you are able to put into stocks and then reset those hedges. That compounding effect, that is the game. I mean, if you really look at what successful investors do, it's that compounding effect of being able to hold risk through rough times and then critically reinvest in those rough times. And that's how they do it.
It's called buy low, sell high.
Yes, exactly right. And it's the put options, because behaviorally that's really difficult, right? We've all been taught that since day one. We all know how hard it is. I thought the American funds, I think when I first started in the business, so I was with Hartford Funds, spent a lot of time in Edward Jones offices, and in all these Edward Jones offices, they would always have that poster, and it was a great poster. It's a little kid, it looked a lot like my son, having to eat broccoli, and this child could not have been more unhappy about what was in front of him. And it said, "This is what buying at the low feels like." And that's a really important thing to bear in mind, that it's never easy to do it. But the beautiful part of having puts in your portfolio is that when you have that there, just like I'm comfortable, driving. I live in Southern New Jersey, a lot of crazy drivers here in the Philadelphia, South New Jersey area. What allows me to feel comfortable driving my car around is I've got insurance.
Absolutely. Well, I appreciate you guys coming on and explaining some of this to our listeners, because it's good to hear from the guys who are actually building these portfolios, watching these portfolios. And I want to also make a comment that if this sounds very advanced, well, it probably is for someone who's trying to do this themselves. So that's why you really should think about turning over the work to a true expert, true professional. These guys know what they're doing. They're using ETFs that have the components we just talked about. Don't try to do this yourself, as they say. Don't try this at home. I mean, it's just not worth it. It's your life savings. So does anybody have anything to add?
Yeah, I was just going to add, if you think about it from like what you need as an investor, if you think you can do it yourself, great. I understand. There's a lot of people who can do that and be successful. But we're an extension of Michelle's team, and it's not just me and Arch sitting here. You have a team of almost 40 people that support Michelle's and her team's investment needs, and that could be anywhere from researching a security to creating portfolios to doing some type of tax transition. There's a lot that goes into the the investment decision-making process and construction of portfolios to be successful. And you have a full team to support with anything under that umbrella.
Yeah, I appreciate your explaining that, because sometimes people think, oh, it's just Michelle and Lauren, and we have a whole back office of experts like you. Thank you so much for spending your valuable time with us today. I really appreciate it.
Thanks for having us.
Absolutely. We really appreciate it, Michelle. Thank you. We really also thank you for your partnership.
Absolutely. It's my pleasure.
Okay, so if you want to access any of this amazing team and their expertise, Michelle, how do they get in touch?
Yeah, the best and easiest way to get in touch is just visit our website, GessnerWealthStrategies.com.
All right. Well, thank you, everyone, and thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.